You're going to buy a house. You're going to feel proud of yourself. And over the next 3 decades, you're going to pay for that house twice, maybe 3 times, and think you got a good deal. That's not pessimism, that's just the math. And the unsettling part isn't that the math is hard to understand. The unsettling part is that it's completely visible, sitting right there in the loan documents you signed, and almost no one stops to actually read it. The 30-year mortgage is the most widely used financial product in American history. Over 90% of homebuyers who take out a mortgage choose a 30-year term. Banks love it. Real estate agents love it. The government backstops it. And for most people, it's framed as the responsible, mature, adult thing to do. But here's what no one says at the closing table. You are not primarily buying a house. For the first decade, you are primarily buying debt. Let's start with a number. The median home price in the United States right now is approximately $420,000. Let's say you put 20% down. That's $84,000, which, by the way, is more than most Americans have in savings. So you're financing $336,000. At a 7% interest rate, which is roughly where the market has been sitting, your monthly payment comes out to about $2,235. Over 30 years, you will pay back approximately $804,000. For a $336,000 loan, that's nearly $470,000 in interest, more than the original price of the home. And again, this is all written in the paperwork. It is not hidden. But the brain doesn't process a number that large, that far in the future, the same way it processes a monthly payment that feels almost manageable. That gap between what something costs and what something feels like it costs is exactly where the trap lives. To understand how this happened, you have to go back about 100 years, because the 30-year mortgage did not always exist. It was invented. Before the 1930s, mortgages in America looked completely different. Loan terms were short, typically 5 to 7 years. Down payments were large, often 50% or more. And at the end of the term, you didn't own the house outright. You owed a balloon payment, the entire remaining principal, all at once. If you couldn't pay it, you lost the house. During the Great Depression, millions of people couldn't pay it. Foreclosures exploded. Roughly half of all mortgages in the country went into default by 1933. It was a catastrophe. So the federal government stepped in. The Homeowners Loan Corporation refinanced over 1 million failing mortgages. And the structure it introduced, the long-term, fixed-rate, self-amortizing loan, became the model. By the 1940s and 50s, the 30-year mortgage was standard. It was designed as a rescue tool, a way to stabilize a collapsing system. The intent was good. The execution solved the immediate crisis. But somewhere along the way, the rescue became the product, and the product became permanent. Here's the mechanic that most people never think about, and it's the part that makes this whole structure so quietly punishing: amortization. When you make your first mortgage payment, it doesn't split evenly between interest and principal. The bank charges interest on the full outstanding balance first. So in the early years of a 30-year loan, the majority of every single payment goes to interest, not toward actually owning more of your house. On that $336,000 loan at 7%, your first monthly payment of $2,235 breaks down like this. Roughly $1,960 goes to the bank as interest. About $275 goes to paying down the loan itself. $275 out of $2,235. That's about 12 cents on every dollar actually reducing your debt in month 1. The rest is the cost of borrowing. And this ratio doesn't flip meaningfully for a very long time. You won't reach the halfway point, where more of your payment goes to principal than interest, until somewhere around year 19 of a 30-year mortgage. Year 19. You've been paying for nearly 2 decades before the balance starts to tip in your favor. Now here's where the psychology becomes architecture. Banks didn't design amortization schedules to be predatory exactly. It's just math. You owe interest on the amount you haven't paid back yet, and at the start, you haven't paid back very much. But the effect of this structure is that it makes the loan extraordinarily profitable to exit early. Profitable for the bank, that is. Because what do Americans do on average every 7 to 12 years? They sell or refinance. They get a new job, move cities, upgrade homes, have kids, get divorced, respond to a low-interest rate environment. The average American moves 11.7 times in their life, and every time they move and take out a new 30-year mortgage, the amortization clock resets to zero. You go back to paying almost entirely interest. Again, this is the loop, not an evil conspiracy, just a structure that happens to reset itself perfectly every time human life intervenes. Banks collect front-loaded interest payments across millions of borrowers who never complete the full term. And borrowers walk away feeling like they made a smart financial move because they built some equity. They did build equity, just a lot less than they think, and at a much slower pace than the payment amount would suggest. There's another layer here, and this one doesn't get talked about enough. The psychological anchor of the monthly payment. When a lender approves you for a mortgage, the number they show you is the monthly number, not the total cost of the loan, not the interest to principal breakdown over time. Just, you can afford $200 a month. And the brain says, okay, that's the price of the house. Stretch the loan term out to 30 years instead of 15, and the monthly payment drops substantially. But the total cost of the loan balloons. On the same $336,000 at 7%, a 15-year mortgage costs roughly $3,020 per month, but only about $543,000 total. The 30-year version saves you $785 a month, but costs you $261,000 more over the life of the loan. That $785 in monthly savings has a price tag of $261,000. Most people would never make that trade if you presented it that clearly. But presented as a monthly number, it feels like relief. It feels like breathing room. And in many cases, for many families, it genuinely is relief, which is exactly what makes this so complicated. The trap works partly because, in the short term, it actually helps. And this is the part where the housing conversation always gets messy, because the counterargument is real. Renting doesn't build equity at all. Your rent payment disappears completely. At least with a mortgage, some of your money is going towards something you own. That's true. But it's also doing a lot of rhetorical work to paper over a specific question. How much equity are you actually building, and how fast? In the first 5 years of that $336,000 mortgage, you'll pay roughly $134,000 in total payments. Of that, about $111,000 went to interest. You've reduced your loan balance by approximately $23,000. So after 5 years and $134,000 in payments, you own about $107,000 of a house, if it hasn't appreciated. The equity exists. It's just slow, and it costs more to create than most people realize. Meanwhile, the word investment gets attached to homeownership with a confidence that doesn't always hold up. Yale economist Robert Shiller, who won a Nobel Prize partly for his work on housing prices, found that inflation-adjusted home prices in the United States increased by less than 1% per year on average over the course of the 20th century. That's not the roaring, appreciating asset that every open house makes it feel like. Some markets, some eras, some properties. Yes, extraordinary gains. But on average, across time, a house is closer to a consumption item than an investment. You're buying the right to live there. The mortgage is the price of that right, stretched across 3 decades. None of this means you shouldn't buy a house. That's not the point. People need places to live. Stability matters. Building equity, even slowly, beats building none. And in high-inflation environments, locking in a fixed payment can be genuinely protective. But there is a difference between a tool and a trap. And that difference usually comes down to whether you understand what you're actually agreeing to. The 30-year mortgage was designed for a specific economic emergency in the 1930s. It was then standardized, marketed, government-backed, and culturally normalized until it became the default assumption of adult life. Not because it was proven to be the optimal financial product for the average family, but because it made housing more accessible in the short term and created a very stable, very long, very profitable relationship between borrowers and lenders. The monthly payment feels manageable. The total cost is staggering. The amortization structure quietly favors the lender for the first 20 years, and the average borrower resets the clock before they ever reach the favorable half of the loan. That's not a bug. That's not a conspiracy. But it is a design, and designs have beneficiaries. So here's where you're left, after all of this. You can fight the math, pay extra toward principal every month, and you can carve years and tens of thousands of dollars off the back end of the loan. You can choose a 15-year term if you can handle the higher payment. You can rent and invest the difference if you have the discipline and the market cooperates. You can buy a cheaper house than the bank says you can afford, which it turns out is almost always the wiser move. Or you can do what most people do, take the 30-year, appreciate the manageable monthly number, and move again in 9 years. There's no perfect answer. The system is large, and you're one person inside it. But here's the question that lingers, the one worth sitting with. If the 30-year mortgage had to be invented to rescue a broken system, and that invention became so normalized, it now shapes how an entire generation thinks about wealth, stability, and what it means to build a life. What else are we all doing on autopilot that someone designed for us and stopped explaining a long time ago?